Let's talk taxes. Alright, let's get into it. You did it. You took the leap. You're a freelancer, a solopreneur, a one-person powerhouse. That is some seriously good news. You're your own boss, setting your own hours, chasing your own dreams. But with great power comes, well, some paperwork. Specifically tax paperwork. Today we're going to talk about something called a 1099 form. Think of it as the freelancer's version of a W-2. It's a form a client sends you, showing how much they paid you during the year. Now, why are we talking about tax traps on September 11th, 2025? Because the best time to deal with taxes is way before they're due. Think of this as a friendly guide, a little roadmap for 1099s and taxes will turn tax time anxiety into confidence. So, grab a coffee, get comfortable, and let's demystify this whole thing. Let's do this. Okay, first up on our list of traps is a big one. It's called the self-employment tax. This one sneaks up on a lot of new freelancers. When you work a regular W-2 job, your employer pays half of your Social Security Medicare taxes, and you pay the other half. But when you are your own boss, guess what? You are both the employer and the employee. That means you're responsible for paying both halves. It's a full 15.3% tax. It can be a real shock if you're not expecting it. Then boom, you get hit with this extra 15.3%. That can turn a manageable tax bill into a financial nightmare. It's the number one reason many freelancers end up owing way more than they anticipated. This isn't a penalty or fine, it's just part of the deal of being self-employed. It's how freelancers contribute to those important social programs, just like everyone else. Ignoring it is like ignoring a big friendly bear that just wants its share of the picnic basket. It will get it eventually. So how do you avoid this trap? It's simple. You just have to know it exists and plan for it. When you're figuring out how much to save for taxes, you need to account for this. A good rule of thumb is to set aside 25 to 30%. That should cover your federal income taxes, state income taxes, plus this self-employment tax. It might feel like a lot, but it's better to oversave than undersave. Think of it this way, that self-employment tax is you investing in your own future. You are your own HR department. So when you see payment come in, mentally high-five yourself, then remember the 15.3%, you're already ahead of the game. This next trap is a direct result of the first one. When you get a big check from a client, it's so tempting to see that full amount as your money. You start thinking about paying off bills, buying that new piece of gear, taking a little vacation. All of those are great things. But if you spend it all, you're essentially spending the government's money too. And they will come asking for it in April. This is how people end up in a panic, trying to find thousands of dollars they don't have. If you don't save, you won't have the money when the tax bill arrives. This can lead to tough choices. Dip into your emergency fund, rack up credit card debt, set up a payment plan with the IRS with penalties and interest. None of these options are ideal. They create stress and can set you back financially for months or years. It turns freelancing freedom into major anxiety. The solution is beautifully simple. Pay yourself first. Then pay your tax self. Open a separate savings account today. Label it tax savings, Uncle Sam's money, or something that reminds you not to touch it. Every single time you get paid, even if it's $50 or $5,000, immediately transfer a percentage into that tax account. Aim for 25 to 30%. Do this consistently, and you'll never panic at tax time. This habit will change your freelancing life. It automates the process and removes the emotion. It's like brushing your teeth, you just do it. When tax time comes, you'll see a nice pile of money waiting. You can pay your taxes without breaking a sweat. If you save too much, enjoy a surprise bonus. How's that for some good news? Alright, let's talk about organization. This next trap is a sneaky one. It feels easier in the moment. It's the mistake of using your personal bank account for all business transactions. You get paid by a client, and it goes right into the same account you use for groceries, Netflix, late-night pizza. You buy a new laptop for work and use the same debit card to buy dog food. It all becomes one big, confusing mess of money. It seems simple at first, but it creates a massive headache later on. This makes it nearly impossible to track your business income and expenses accurately. When tax time rolls around, you go through a whole year's worth of bank statements, line by line, trying to remember what was a business lunch and what was a birthday dinner. Was that Amazon order office supplies or a gift for your cousin? It's not fun, it's time-consuming, and you're likely to miss valuable deductions, which means paying more in taxes. It also looks unprofessional if the IRS has questions. The solution is simple. Open a separate bank account just for your business. It doesn't have to be fancy. A second, no-fee personal checking account dedicated to your freelance work works fine. Have all client payments go into this account. Use its debit card for every business expense, new printer, website hosting, software subscriptions, coffee with a potential client. Now you have a clean, clear record. All your business finances are in one place. To find your profit or expenses for the year, you just check one account. It's like a pre-organized filing cabinet for your money. This single step saves you dozens of hours of stress and likely hundreds or thousands on taxes. It's a total game changer. Now that you have your separate business account, let's talk about what you're spending that money on. This brings us to our next trap: not taking all the deductions you're entitled to. A business deduction or a write-off is a business-related expense you can subtract from your income. That lowers your taxable income, which means you pay less in taxes. It's the government's way of saying, we know it costs money to make money, so you don't have to pay tax on what you spent to run your business. Many freelancers are too timid and leave money on the table. Why is this a big deal? Because every dollar you don't deduct is a dollar the government gets to tax. If you're in a 22% tax bracket, every $100 in deductions saves you $22 in cash. That adds up fast. Forgetting to deduct your internet bill, your cell phone, your office supplies, your professional development courses is like willingly giving away your hard-earned money. You wouldn't hand a stranger $22 on the street, so why hand it to the IRS? Claiming legitimate deductions isn't cheating, it's smart. The solution is twofold. First, know what you can deduct. The list is long: part of your rent, part of your mortgage, a portion of your utility bills, your cell phone bill, your internet bill, software you use for work, subscriptions to industry journals, courses to improve your skills, mileage you drive to meet clients, fees your bank charges on your business account. Rule: expense must be ordinary and necessary for your work. Quick search for common freelancer deductions gives a great starting list. Second, track expenses meticulously. Your separate business account helps. Keep receipts, digital is fine, and note what each expense was for. Use a simple spreadsheet or bookkeeping app. This trap is the cousin of the last two we talked about. It's the classic shoebox full of crumpled receipts. You know you're supposed to keep records, so you stuff every receipt into a box thinking, I'll deal with this later. Later comes, and you're faced with a chaotic mountain of paper. You have to sort it, decipher it, and add it up. It's overwhelming, it's stressful. It makes you want to give up and just guess. Guessing is not a good tax strategy. Messy records are a recipe for mistakes, missed deductions, and major audit anxiety. The shoebox method is inefficient and prone to error. Receipts fade, you forget what they were for, you lose them. If the IRS asks you to prove expenses, which they can for several years, that shoebox won't be convincing. You need a system. Good record keeping is the backbone of good business. It prepares you for tax time and shows your business's financial health year-round. You can see where your money is going and make smarter decisions. The solution? Ditch the shoebox and go digital. In 2025, there's no reason to drown in paper. QuickBooks Self-Employed, FreshBooks, Wave, free. These can connect directly to your business bank account and import transactions automatically. Use your phone to snap a photo of a receipt. It gets stored digitally and attached to the right transaction. It's like a tiny, super organized bookkeeper in your pocket. It turns a dreaded chore into a simple daily habit. Prefer hands-on? Use a spreadsheet. Set aside 15 minutes every Friday to log expenses. 15 minutes a week saves you hours next April. Your future self will thank you profusely. Okay, let's tackle a topic that sounds intimidating but is actually pretty straightforward. It's the mystery of quarterly estimated taxes. Here's the deal. Because taxes aren't being taken out of your paychecks, the IRS doesn't want to wait until next April to get all of its money. They want you to pay your taxes as you earn income throughout the year. So, they ask self-employed people who expect to owe more than $1,000 to pay it in 4 installments. These are called quarterly estimated tax payments. They are due in April, they are due in June, they are due in September, they are due in January of the next year. The trap here is simply not knowing this is a thing. Many freelancers are surprised to learn they can't just pay one lump sum on tax day. If you ignore these quarterly payments, you can be hit with an underpayment penalty. It's basically a fine for paying your taxes too late. It's not huge, but it's completely avoidable. It's like getting a late fee on a library book. We want to avoid any and all extra fees. So how do you solve this mystery? First, you have to figure out if you need to pay them. The simple rule is if you expect to owe $1,000 or more, you should be paying quarterly. For most full-time freelancers, this is a yes. To calculate how much, estimate your total income, subtract business deductions, calculate total tax including that 15.3% self-employment tax, then divide that total by 4. The IRS has a worksheet called Form 1040 ES that can walk you through it, or many tax software programs can help. The simplest way? Use that 25 to 30% rule. Take income from the last 3 months, calculate 25 to 30% and send that to the IRS. You can pay online through IRS Direct Pay. It's fast and easy. Making these 4 payments keeps you on the right side of the rules, avoids penalties, and makes tax day much smaller and more manageable. This might sound meta, but a common trap is not handling the 1099 NEC forms correctly. Let's break this down. The 1099 NEC is the form we talked about at the beginning. It's sent if they paid you $600 or more. NEC stands for Non-Employee Compensation. You should get one from every qualifying client by January 31st. A big mistake is thinking that if you don't get a 1099 from a client, you don't have to report that income. This is a huge trap. You are legally required to report all income whether you receive a 1099 or not. The form is just informational that the client also sends to the IRS. So, the IRS already knows you were paid. If you forget to report income from a client who did send in a 1099, the IRS computers will automatically flag the mismatch. This is one of the easiest ways to get a letter from the IRS, back taxes, penalties, interest. You have to report everything. The solution is to be your own best record keeper. Okay, we've been through a lot. We talked about self-employment tax, saving money, separating accounts, finding deductions, keeping good records, paying quarterly, handling those 1099 forms. It can feel like a lot, but take a deep breath and look back. None of it is rocket science. Every single trap has a simple, straightforward solution, and you are more than capable of handling every one of them. This is not a test you have to cram for. It's a system you can build. Being a freelancer is about building a life on your own terms. It's about freedom. It's about flexibility. It's about passion. Don't let the administrative side steal your joy. By putting these systems in place, you're treating your freelance career like the real, legitimate business that it is. You're being a professional. And that's something to be incredibly proud of. You've got this.